Hello, everybody, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Kinsey Grant, and we are here with you today to discuss some big news affecting the debt market. We're going to talk about the overall debt market atmosphere, current behavior, expectations for the next couple of weeks and months, and we're super excited to get some wonderful insights from our guests, who I will introduce in just a second. Now, before we get to that, don't forget to like, comment, and subscribe to our YouTube at Public Invest for in-depth interviews to help you keep your portfolio on track. So, like I mentioned, today we are talking about the debt market, and we are super excited to have a great guest on today to do that with us. I'm excited to welcome Jared Dillian, founder of the Daily Dirt Nap. Jared, welcome to Public. How are you?
Hey, I'm doing good, thanks.
Awesome. Yeah, I'm glad to have you here. It's been, we're recording this right after jobs report came out for September on the first Friday of October. And it has definitely been a pretty turbulent week for the debt market, broadly speaking, especially in light of this jobs report. Stronger than expected September jobs report, pushing 10-year treasury yields to around a 16-year high. So tell me a little bit about what's going on, how this jobs report impacts the debt market, and why that might make investors take a more pessimistic or at least a less optimistic view of the debt market this week.
Well, just for starters, going into the report, the bond market is in extremis. I mean, it's almost at crisis levels. I mean, and one thing about interest rates is that, a lot of people focused on the level of rates themselves, but what's more important is really the speed and the speed at which they move. And we went from 4% to 4.7% on tens in a month. And if that happened over a year, it wouldn't be a big deal, but it happened in a month and it's causing a lot of problems. I've sort of picked apart the payroll number today, and it's a strong number. Like I've seen some questions about the seasonality calculations in the BLS, how they failed to account for teachers going back to work, and I've seen some other people questioning the number of part-time workers versus full-time workers. But even if you strip all that out, it's still a pretty strong report, and the revision to last month was up. So, it really, if you look at the 12-month moving average of payrolls going back to last year, like we had definitely been trending down. And this report is a little bit of an aberration. It's like I said, it's definitely a strong report. Under the circumstances, the price action in the bond market isn't all that bad. You're looking like I'm looking at my screen right now. Yields are up a bit. It's definitely not a crash in the bond market. It was a little ugly right after the number came out, but things have sort of recovered. And, I think that when it comes to economic data, what's more important than the actual data is the price action around the data. And if you can see the bond market recover more than half of its losses on what essentially is a blowout payroll number, then I think that's actually pretty positive. So it kind of feels like bonds are bottoming here.
Okay, interesting. Yeah, and this idea of speed, I think that this rapid way that things change, whether that's interest rates or price action, I'm interested to hear a little bit about how that kind of finds its footing. How you mentioned we might sort of be bottoming out a little bit. How does what's your expectation, I guess, for the speed with which we kind of get back to more solid ground in terms of what we'd expect of the bond market of debt right now?
Well, first of all, a little history. I mean, if you go back to 1994, 10-year interest rates backed up 200 basis points in a couple of months, and a lot of things blew up. Like Orange County blew up, and Procter and Gamble, and a lot of people had derivatives exposure to interest rates. We haven't really seen that. We haven't seen banks blow up. We haven't seen anything blow up as a result of this move in rates, at least not yet. Which is a little bit surprising because that exposure does live somewhere. Um, I'm gonna say that I don't think we're going to get another rate hike. I don't think we're going to get another rate hike in November. You've seen some comments out of some people at the Fed saying that really the long end of the yield curve is doing the tightening for them. When you get mortgage rates up to 8%, like it kind of doesn't make sense to hike interest rates. The back end is doing it for them. So really what's been happening, and I know I'm not answering your question, I'm just sort of like talking off the top of my head. Really what's been happening is we've had this really big steepening in the yield curve. The yield curve was massively inverted. And then over the last couple of weeks, it's steepened about 70 basis points. And if the Fed does pause or cut rates eventually, you're going to see that steepening continue. And that unwind of this inverted yield curve is going to happen very, very rapidly. And it's a very popular trade. So.
Right. Now, this idea of the inverted yield curve, for most of my time covering this space, has always kind of been a little bit of not a bad word, but something that people certainly pay attention to. So I'm curious to understand your perspective with all of this taken into consideration: the September jobs report that was stronger than expected, your expectations for Fed policy in November. I'm just curious to hear what you would say is kind of the general health right now. What is the perception that people should have of how the economy is doing? I think it's been sort of a common retort I've seen over the last several months and weeks, especially, of saying, no one really knows where to look. Nobody knows what to pay attention to. Nobody knows how to understand how the economy is doing, what the health of the economy is. And of course, this is a complicated question with many, many factors and many facets. But I even saw a headline today, September jobs report beats expectations despite troubling economic realities. Tell me a little bit more about how this idea of kind of where we go next, how we can figure that out based on what we know now, knowing that this threat of a recession has been around for some time and everybody defines it differently. I mean, how should investors be going about their decision making over the next couple of weeks, knowing that we're getting a lot of different inputs and a lot of different perspectives on how the economy is doing, broadly speaking? What's your take here?
Well, I think the economy is kind of mixed. I think it's weak in some areas and strong in some areas. And, um, if you look at the manufacturing surveys, I mean, just, earlier this week, Chicago PMI came out at 44. I mean, if this was 2002 and Chicago PMI came out at 44, the Fed would be cutting rates 50 basis points intermeeting, you know. So manufacturing is weak, and I've also gotten a lot of anecdotal information from manufacturers that have indicated that the phone has stopped ringing, they don't have new orders, manufacturing is weak. The labor market is still strong, which is weird because if you look at corporate tax receipts, they're down a little bit over 2%. And corporate tax receipts are a good thing to keep an eye on because, that's the income that corporations actually report to the government, which is really the income that they can't hide or conceal, or, I mean, that's the actual money that they earn. And if tax receipts are down, then you would think that you would get layoffs at some point. So I think it's very mixed. And as far as a recession, like we talked about the inverted yield curve. When the yield curve first inverts, that's a signal that you're going to get a recession. And then when it steepens, when it uninverts, that means that the recession is here. And that's what's happening now. Like the yield curve is steepening, which means the recession should be happening as we speak. And yet the jobs market is just defying expectations. And also real estate, like real estate's kind of interesting because prices are on the highs, but transaction volume is down for a whole bunch of reasons. So it's really confusing. This is not a traditional recession like you might think of, like that we've had in the past. So
Yeah, it's certainly been an interesting road to get to this point. I think the most accurate descriptor I've heard, it's just things feel topsy turvy, things feel a little funky. But with all of this in mind, one of the big topics of conversation for anybody who's trying to understand the macroeconomic realities that we're facing right now is, of course, inflation, and that is one that I would love to hear your take on. We've talked a little bit about some of these various elements that are impacting debt markets, that are impacting investors just trying to understand the economy a little bit better. But what's your take on inflation right now?
well, I think people pay a lot of attention to inflation right now because they're seeing it in places that are obvious, like food.
Mm-hmm.
Food prices are 40% higher than they were at the beginning of the pandemic. So when they go in the grocery store, if they had a cart full of groceries that was $100, now it's $150, and people notice that. And people still have this sort of recency bias. They remember what it was like before, so they complain about inflation. But really, inflation has dropped a lot. If you look at the Trueflation numbers, it's in the two handle. We have 2.6% inflation or something like that. But we still have inflationary pressures. And what you're seeing right now is that prices went up, and you have workers that are now fighting for higher wages to keep up with the higher prices, which is going to result in higher prices, which is going to result in higher wages. And in the 70s, they called this a wage price spiral. And that's kind of the danger of what's happening. And really, this is all psychological. Inflation is not an economic phenomenon; it's completely a psychological phenomenon. If people believe that prices are going to go higher, they will act in such a way that causes prices to go higher. So even though inflation has come down from 9% to 3%, there is a real danger that it will come back at some point in the future. And if you look at the path of inflation in the 1970s, you really had three waves. In 1969, inflation got up to about 5%, then it came down, then it came up in 1974, and it came down, then it came up in 1979. And, that continued until we raised rates enough that we caused such a severe recession that it broke that psychology. And, we've had a rapid tightening of monetary policy. The Fed has raised rates a lot. Uh, it's clear that they haven't broken the psychology, so it will be back at some point in the future.
Yeah. It's really interesting to perceive that as something psychological. Obviously we know that the economy is largely based on the psychological whims and feelings that we have as participants within it. But it's interesting to consider that what we see on a carton of eggs is not necessarily just some made up decision, right? It's the it's driven by a lot of factors, many of which we are participants in. Now you talked about the monetary stuff. I want to get your take quickly before I let you go on the fiscal side of things. We have had a lot of whispers and frankly louder than whispers talks of a recent fears over this government shutdown. Congress recently passed a short-term spending bill that'll get us till about the middle of November to come up with a better solution to avoid a full shutdown. But with news this week about House Speaker Kevin McCarthy being ousted, first time in U.S. history this has happened, I just want to hear a little bit about your perspective on what a potential government shutdown and what just turmoil within the House means right now. We're talking specifically about debt markets at the beginning of this conversation. So I'd love to hear your perspective on it, what it means for debt, but also just kind of for the economy, broadly speaking. What does a government shutdown look like for those of us who want to understand what comes next, economically speaking?
Well, I'm definitely not an expert on politics, but I can tell you that, like, I don't pay any attention to the drama and intrigue of McCarthy getting ousted. I don't really care about that. And I don't really have a super high opinion of the people that ousted him. But having said that, I think it's a good thing that we are having discussions about debt and deficits for the first time since probably the 1990s. Um, like I'm old enough to remember when Reagan was president and people were freaking out about the deficit when it was about 5 or 6% of GDP. And I worked for the government when Clinton was president, and still we were continuing this austerity, and we actually balanced the budget in 2000. It was kind of funny because when I started working at Lehman Brothers, nobody wanted to be a treasury bond trader because they thought there would be no more bonds left to trade. Thought we would pay them all off. That was actually the thinking at the time.
Wow.
Then 9/11 happened and we started spending a lot of money again. So, I've kind of seen this whole path over the years, but what I remember from the 80s and 90s was that the debt was really the biggest political issue for people. Like, people were really obsessively focused on it, on getting the debt down. And then, post 9/11, nobody cared about the debt or the deficit. And it hasn't been a political issue since then. And I think it's kind of a good sign that people are starting to care about it. We're running almost a $2 trillion deficit in peacetime. And if you go into the CBO website and you start breaking it down and you look at like what's discretionary spending and what's entitlements and stuff like that, like, it's very hard to get out of this without making some very serious changes. And I think we're at the very beginning of that. I think people are starting to talk about it. I think a government shutdown is theater, but it's good because people are finally having these discussions. So
Yeah, absolutely. And just to kind of think a little bit more future forward right now, with I think we're debt is at what, somewhere around $30 trillion US debt, national debt. Do you think that this, especially given your comments before about the way that yields are changing, and the speed with which they are changing, do you expect that there's ever a possibility that the government maybe can't obtain the kind of debt that it does now down the road, or faces more difficulty in doing so, knowing that the debt right now is as high as it is and that yields are changing the way that they are?
Well, that's already happening. I mean, it's happening as we speak. The reason that yields are where they are is not because of inflation. It's not because of the economy. If you notice, if you pay attention to the bond market on an intraday basis, it doesn't respond to economic data at all. Like, I mean, it is today's payrolls, but in general, it doesn't respond to economic data. People are concerned about supply. People are concerned about auctions, how much debt we are issuing, and that's why it's backing up. So really, like in the 90s, they would call this the bond market vigilantes, right? Like in the bond market vigilantes were imposing discipline on the government. And that happened in 1994 because in early 1994, you had discussions about Hillary care and big government and stuff like that. And interest rates went up a lot, and they had to stop having those discussions. And then, Newt Gingrich took over in the fall of 1994, and you had a Republican Congress. And, then you had austerity for the next 6 years. So something similar might happen this time.
All right. Any other big expectations that you want to chat about today going into the rest of 2023 and early 2024? Anything on your mind?
No, I don't think so.
Okay, we hit the big ones. We certainly did. Thank you so much, Jared, for joining us today. I really appreciate you taking the time to walk me through all of this and give some really valuable insight on what's been going on, because it has been a weird couple of weeks in economic news, and I appreciate you helping us kind of guide toward what could come next. So thank you.
Yeah, absolutely. Thank you.
Thank you once again to our guest, Jared Dillian, founder of the Daily Dirt Nap, and thank you to all of you for listening. I'll see you next time.